Welcome to the great debate. To dividend or not to dividend? That is the question. You know, it seems that there's people on either side of the camp. There's die-hard dividend investors who absolutely live and die by the sword. When the dividend goes up, they just go, yes! And there's other people on the other side of the aisle who oppose dividends utmost, like with the utmost opposition possible. But who's right? I want to unmask some of the misinformation and just shine a little light on what is a dividend, why a company may pay it, and what are the pros and cons to it, so that you can make a better informed decision for your portfolio. When a company has a choice to distribute profit back to the shareholder, they can do a lot of different things with that money. Now, they can reinvest in the company. Maybe it's a Starbucks and they're young, they've only got a few hundred stores, and they say, our cash is best spent opening more stores, getting our footprint out there, getting our buying power, maybe buying some, manufacturing facilities or plants or distribution plants. So we're not going to pay a dividend because that would limit our ability to grow. And we're a young, thriving company and we're really going to take over the marketplace. So they don't pay a dividend. And then you've got other companies, other industries even, that are regulated, that for tax purposes and for status, they have to pay a dividend, and a lot of them have to pay a percentage of their earnings as a dividend. The two that come to mind that you'll probably understand or be familiar with most is REITs and utilities. So utility companies, very common. Gas, electric, water, utility companies, pipelines, etc. And then you've got REITs, which are real estate investment trusts. Now, when you have profit and you're looking to distribute it, like I said, there's many different things you can do. The most common one is for a company to reinvest in itself. But eventually that company is going to grow to a point where maybe it doesn't make as much sense to reinvest in itself. And they've got other levers that they can pull. So a company can reinvest in itself, called equity, return on equity. How much of a return does the company make on the money it invests? What does it invest in? New stores, R&D, streamlining processes, new plants, real estate, land, whatever it is. But they can also use that money to pay down debt. Or they can use that money for a strategic merger or acquisition, maybe a competitor or a new business venture or a revenue stream that complements their current business. Or they can reward shareholders. They can do a dividend. Maybe it's a regular dividend or a special dividend. So there's many different things that a company can do with their profit, with their earnings. Now, when they choose to pay a dividend, depending on what kind of company they are, that's either a good thing and the market rewards them, or it's a bad thing. I'll give you an example. So Yeti Coolers is a company that's been around for probably a decade. I haven't followed them since the start, but they've been a private company up until recently. And they launched their IPO, I believe, just about a year ago. Now, Yeti Coolers is still a young company, and they went through the process of going public. And although they have a phenomenal product, they're young in the marketplace as far as a public company. So if Yeti Coolers all of a sudden went out and started paying a dividend, I would have great cause for concern as to why in the hell are they paying a dividend? Because they should be focused on getting their cost of production down, on getting their distribution channels up, on increasing their margin, on growing their footprint, on growing their distribution channels, on making sure that they've got contracts lined up with retailers, whatever it is, on research and development, growing their product, on branding, on marketing. And eventually, one day down the road, maybe they choose to pay a dividend. So just because you collect a dividend doesn't mean that's a good thing. If you have the time and the curiosity, or maybe you are one of the unfortunate souls who owned GM during the '08 crisis, GM started to do what is sacrosanct, which you never ever do. And if you see management do it, you better take very good look, a very good hard look at that company to see if you want to own it. And that's they borrowed to pay the dividend. See, they were so concerned that the perception from the marketplace, if they stopped paying the dividend, would crash their stock price. But that's what happened anyway, because they borrowed so much to pay their dividend. Now, there's many other factors that went into that decision, but understand that that is a poor decision by management. That is a horrible idea. You want stewards of capital that are going to help you sleep at night. Management teams that have high integrity, that really understand that returning value to shareholders sometimes means not paying a dividend. So if you rely on a dividend for income, maybe you're retired or semi-retired, there's some key metrics that you really want to pay attention to. And maybe you're already aware of them, but we're just going to do a bit of a refresh here. 1, what is the dividend growth? You can go back, you can probably pull it off the investor relations website of your company and just look, what is the track record? Are they a long-paying dividend company? Are they a dividend aristocrat? Are they a dividend-paying company that's consistent? Do they constantly raise their dividend? If there's been times when they've cut their dividend, suspended it, or reduced it, what was going on? What happened to lead to that decision? Really make sure you understand what causes this company to move back and forth on the dividend. 2, what is the dividend payout ratio? If the company starts saying, yes, we're going to raise the dividend, we're going to raise it 10 or 15% next year, and the dividend payout ratio is at 95%, well, how are they going to squeeze that extra money out? Because things happen in a company. You can have an account go bad, you can have a recession, you can have a health crisis, you can have a hurricane. There's so many things that could happen to a company that are outside of its control. That's why you need to have a buffer. A company can execute on a plan 110%. They can be firing on all cylinders, doing everything right. And then, boom, a coronavirus can come and just completely derail the plan. So you want to make sure that the dividend payout ratio is something that's going to allow for surprises, something that's going to allow for the ebbs and flows of business, something that's going to allow for room for growth. That way you can sleep at night. On top of that, how does management get paid? How are they rewarded? You want to make sure that that aligns with your vision, your values. That way, when you know your dividend is protected. 2, are your dividends diversified? If you own nothing but, rental REITs, that's not really diversified. If something happens to the rental market, a big chunk of your income might be at jeopardy. So you want to make sure you have different sectors paying your dividend. What are the tax implications for your dividend? If you're using that for income or you're reinvesting it back in to grow. Do you get a discount? That's something that is not as common anymore, but when I started, when I was 16, I actually bought physical share certificates in street name. I had to actually get a broker, actually it was a retail bank, to stamp my share certificate. And that share certificate was something that you actually could trade back and forth and buy and sell shares that way. This is like almost 20 years ago. Yeah, much different time back then. But make sure that you follow these. Understand that it's not always a good idea to pay a dividend. In fact, if you have a high growth company, a company that's really taken off and it has a long runway ahead of it, like say Apple 10 years ago or Starbucks 10 years ago, if management starts to declare a dividend and starts to pay out a dividend, understand that that's a big red flag. Why are they paying a dividend? Are they trying to buy confidence from the marketplace? Right now you see a lot of oil and gas companies and their dividend is 8, 10, 15, 21%. You see mortgage companies, 15, 18% dividend. And a lot of people are getting very frothy about this. They're getting really excited. But you should be very skeptical. Why is that company paying such a high dividend? Is it a temporary event that just dropped their share price? If so, this could be a phenomenal opportunity for you to get in there and buy something and have a much higher yield. Or is it something that's going to have to be corrected? Are they going to have to trim down their dividend because it's a new norm? Oil prices are suppressed, interest rates have skyrocketed, something's happened that's going to enable them from being able to consistently pay that high dividend. There are things that can change. But one thing that you should understand, if a company is high growth like I mentioned, you don't want them to pay a dividend. For tax reasons and for growth reasons, the best thing they can do is plow that money back into the company. A lot of high growth companies will grow their ROE, their return on equity, 20, 30, 40% a year. That's insane. Go look at Apple's return on equity, even now, when, as it was approaching $1 trillion market cap. And their return on equity is insane. So if they can make 25 or 30% return on the money that they reinvest in themselves, why do you want a 5 or 6 or 7% dividend? The marketplace recognizes the value in the share price. So if they can grow at 20 or 25% for 5 or 6 or 10 years, well, it's very likely your share price will follow in lockstep, which means that your share price will climb 20 to 25 or 30%. So don't be so focused on the dividend, 5 or 6%. That might be the thing that's actually holding you back from making more money. And I hope that helps. Have a great day.